If you are a pensioner living in the United Kingdom, you need to pay very close attention to your bank account and your mailbox this week because a massive shift in how the government monitors your money has officially begun. As of April 2026, the Department for Work and Pensions has been granted unprecedented new powers to perform automated bank checks on millions of citizens, and the latest data suggests that a staggering 32% of all seniors are directly impacted by these new rules. While the headlines often focus on younger benefit claimants, the reality is that the silver generation is at the very heart of this regulatory overhaul. And if you are among the millions receiving pension credit or other means-tested support, the boundary between your private savings and the eyes of the state has just become much thinner. This is not just a minor administrative update. It is the full implementation of the Public Authorities Fraud, Error, and Recovery Act 2025, and it represents a fundamental change in the social contract between the British government and its retirees. The reason that 32% of seniors are currently in the crosshairs of the Department for Work and Pensions is directly linked to the high number of older adults who rely on pension credit to top up their basic state pension. For years, the government has struggled to manage the nearly £10 billion lost annually to fraud and error, and they have identified the pensioner population as a key area where unintentional errors regarding savings and overseas travel often occur. If you are one of the approximately 1 in 3 pensioners who receive any form of means-tested benefit, your bank is now legally required to flag your account to the authorities if it meets certain criteria. It is vital to understand that the standard contributory state pension is currently exempt from these checks, but the moment you receive even a single pound of pension credit, housing benefit, or council tax support, your financial privacy changes. The government is essentially turning the nation's biggest banks, including Barclays, Lloyds, and NatWest, into digital watchdogs tasked with spotting eligibility inconsistencies before they turn into massive overpayments that the state then has to claw back. The first major trigger that the Department for Work and Pensions is looking for involves the strict capital limits associated with pension credit. Under the current 2026 rules, if you have more than £10,000 in savings, your weekly benefit starts to be reduced, and if your total capital exceeds £16,000, you generally lose your eligibility for means-tested support altogether. In the past, the government relied on self-reporting, which meant many pensioners accidentally exceeded these limits after receiving an inheritance, an insurance payout, or the proceeds from a house sale without realizing they needed to notify the pension service. Now, the new automated system sends an eligibility verification notice to your bank, which then scans for any account that has remained above the £16,000 threshold for more than 3 consecutive months. This is a digital tripwire that sends a silent flag to the authorities, who will then contact you to explain where the money came from and why it wasn't reported. For many seniors who are simply saving for a rainy day or keeping money aside for funeral costs, this sudden scrutiny can be deeply distressing, but the law in 2026 is clear. The state now has a direct window into your total savings balance. The second primary focus of these new bank checks is the controversial 4-week rule regarding travel abroad. Pension credit regulations specify that a claimant can usually only continue to receive payments if they are away from the United Kingdom for no more than 4 weeks at a time. In an era of global travel, where many pensioners spend the winter months visiting family in warmer climates or staying in second homes, the government has found that thousands of people are inadvertently breaking these rules. Starting this April, banks are being asked to flag accounts that show exclusive activity, such as ATM withdrawals or card payments, occurring outside of the United Kingdom for more than 28 consecutive days. If the Department for Work and Pensions sees that your pension is being spent entirely in Spain or Australia for 2 months straight while you are still claiming UK-based means-tested benefits, they will view this as a red flag for non-compliance. This is one of the most significant ways that the 32% of impacted seniors could find their income suddenly suspended or subject to a formal review. What makes this situation particularly urgent in 2026 is the human-in-the-loop promise that the government has made to ease public anxiety. The Department for Work and Pensions has stated that no pension or benefit will be stopped by an algorithm alone. However, being flagged by the system means that a formal investigation is opened, and a caseworker will be assigned to look into your financial history. This often results in a letter arriving at your door, asking for several months of bank statements and an explanation for specific transactions. For the 32% of seniors impacted, this process can feel like being treated like a criminal for simply managing their own money. It is a period of high friction that many campaigners argue is unfair to a generation that has already paid into the system for 40 or 50 years. Yet, the government insists that with the state pension age rising and the cost of living putting immense pressure on the national budget, ensuring that every penny of pension credit goes only to those who strictly qualify is an economic necessity. There is also a growing concern regarding digital exclusion as these rules are rolled out. Many of the 3 in 10 seniors affected by these checks do not use online banking or smartphones, making it much harder for them to track their own balances or respond quickly to government inquiries. If your bank flags your account but you don't check your mail regularly, or if you have moved house without updating your records, your benefits could be suspended before you even realize there is a problem. The April 2026 update is a reminder that the world of paper passbooks and face-to-face bank manager meetings is truly over. Your financial life is now a series of data points that are being shared between private corporations and the state at lightning speed. To stay safe, you must ensure that your contact details are absolutely current and that you have a clear understanding of exactly how much money is in every one of your accounts, including individual savings accounts and premium bonds, as these all count toward your £16,000 limit. Beyond the technicalities, there is a sinister side to this update that every pensioner must be wary of, and that is the rise of the verification scam. Criminals are already aware that 32% of seniors are nervous about these new Department for Work and Pensions rules, and they are sending out fake text messages and emails claiming that your bank account has failed a DWP check. These messages often ask you to click a link and enter your banking password or your national insurance number to clear your name. You must remember that the official government checks happen directly between the bank and the state. The authorities will never send you a text message asking for your login details. If you receive a suspicious communication, hang up the phone or delete the email immediately. The real Department for Work and Pensions process involves formal letters or messages through your official online journal if you use the digital system. Staying vigilant against these predators is just as important as following the new rules themselves. As we move past the April deadline, the impact on the 32% of impacted seniors will become even more visible. Local citizens' advice offices and pensioner charities are already reporting a surge in calls from people who are confused about why their bank is asking them to sign new data sharing agreements. The reality of 2026 is that the government is looking for ways to reclaim billions of pounds, and the unreported savings of the elderly is a primary target. If you are among the millions of people who worked hard and saved a little extra for your retirement, you are not being punished for your thrift, but you are being held to a much higher standard of reporting than ever before. You must be transparent about every pound you own. If your savings dip below or rise above the £10,000 mark, you should report it immediately to avoid the system triggering a flag that could lead to a stressful audit. The broader political landscape of 2026 also plays a role in why these rules are being pushed so hard right now. With the national debt remaining high and public services under strain, the government is using big data to ensure the welfare system is as efficient as possible. They argue that by catching errors early through these bank checks, they are actually helping pensioners avoid falling into debt traps where they owe the state thousands of pounds in overpaid benefits. However, for the 32% of seniors who are the focus of these measures, it feels like a heavy-handed approach to a problem that could be solved with better communication and clearer guidance. The tension between the need for state efficiency and the right to individual privacy is at its peak this month, and the pensioner population is the primary testing ground for this new era of digital governance. In conclusion, the Department for Work and Pensions bank check rules for 2026 are a landmark shift that every senior citizen needs to understand. Whether you agree with the policy or not, the fact remains that if you receive means-tested support, your bank account is no longer a private sanctuary. By understanding the 32% impact, keeping a close eye on the 16,000-pound capital limit, and being mindful of the 4-week travel rule, you can navigate these changes without losing your vital income. The goal of the 2026 update is to modernize the system, but for the individual pensioner, the goal must be protection and preparation. Don't let the April rollover catch you off guard. Check your balances, report your changes, and stay informed about your rights in this new financial world. The bus pass, the winter fuel payment, and the pension credit are all hard-earned rights, but in 2026, they come with a new requirement for total financial transparency. Stay alert, stay honest, and make sure you are on the right side of the new bank check rules. One major group finding themselves in immediate financial peril is the thousands of retirees who have reached 66 this month only to find their state pension eligibility has vanished. This is due to the gradual increase in the state pension age from 66 to 67, which officially kicks into a new phase in April 2026. If you were born between April 6, 1960 and March 5, 1961, you are part of the critical cohort whose retirement date is being pushed back by several months or even a full year. This has created a massive income gap for those who had already handed in their notice at work or planned their finances around a 66th birthday payout. Many of these individuals are now being forced to claim universal credit just to survive. But even that is under threat. Plus one, this April 2026 update also includes a devastating cut to the universal credit health element for many new claimants. If you are a senior who is not yet at pension age but relies on health-related benefits, the monthly payment for limited capability for work and work-related activity is being slashed from over 400 pounds down to just 217 pounds. This massive drop is a permanent change that will be frozen for 4 years, meaning its real-world value will continue to fall as inflation bites. The only way to have avoided this cut was to have established your claim before the April 5th deadline, leaving thousands who fell ill after that date in a much weaker financial position. Furthermore, over 700,000 civil service pensioners are currently caught in a massive administrative failure following the transfer of the scheme to a new provider. Since early 2026, thousands have reported that their monthly payments have simply stopped or been severely delayed. While the government has launched a recovery plan including interest-free loans of up to £10,000 for those in hardship, the stress of not knowing if your rent or mortgage will be paid this month is overwhelming. If you are a retired civil servant and your April pension has not arrived, you must contact the new administrator, Capita, immediately to request an emergency hardship loan. The government has admitted this is a failure of the highest order, but the burden remains on the individual to fight for the money they are owed. Adding to the complexity is the new tax year 2026 annual allowance rules for those who are still trying to save for their future. The annual allowance remains at £60,000, but for those who have already started to draw down from their pension, a process known as Flexi Access, the amount you can put back in without a massive tax charge is limited to just £10,000. Thousands of older workers who took a small lump sum during the cost of living crisis are now finding themselves unable to rebuild their savings without being penalized by the tax man. This is a hidden trap that many don't discover until they receive a shock bill from HMRC. Plus one, the combined effect of these changes, the bank checks, the rising pension age, the health element cuts, and the administrative chaos, is a perfect storm for the UK's elderly population. It is estimated that by the end of this month, nearly 50,000 people will have lost at least one of their regular payments or seen a significant reduction in their household income. This is why it is so critical to go through the full checklist. Check your birthday against the new state pension age, check your savings against the £16,000 limit, and check your bank statements for any errors in your civil service or private pension deposits. The government maintains that the 4.8% increase in the state pension, bringing the full new rate to £241.30 per week, is a shield against these pressures. But for those losing hundreds of pounds in pension credit or facing a year-long wait for their state pension to start, a small weekly increase is cold comfort. We are living through the most significant transformation of the British retirement system in a generation, and the cost of being uninformed has never been higher. As we move through the rest of 2026, stay close to your financial records and do not be afraid to challenge any decision that looks wrong. The authorities are using algorithms and automated systems more than ever, and these systems are not perfect. Your voice and your vigilance are your best defense. As the April 8th administrative rollover passes, the first wave of automated flags will start reaching caseworkers. If you receive a phone call or a letter from the Department for Work and Pensions this week, do not panic, but do not ignore it. Gather your evidence, prove your eligibility, and ensure that you are not one of the thousands who lose their payments this year. The UK pension alert is real, and the time to act is now. Keep your savings declarations updated, watch your travel days, and protect the income you spent a lifetime earning. The 2026 landscape is tough, but by staying informed and active, you can weather this storm and ensure your retirement remains as secure as possible. Stay safe and stay updated on every change to the list.